Lennox International, ticker LII on the NYSE, the North American HVAC manufacturer sitting at the intersection of two secular tailwinds, the CARR regulatory replacement cycle and hyperscaler data center cooling demand, generating $5.87 billion in revenue at best-in-class operating margins.
Founded in 1895 in Marshalltown, Iowa, headquartered today in Richardson, Texas. 12,000 employees. Fiscal 2024 revenue of $5.87 billion. Adjusted operating margin of 19.8%, best in class among North American HVAC manufacturers. Free cash flow of $700 million.
Dave Lennox invented the riveted steel furnace in 1895, applying industrial manufacturing methods to residential heating for the first time. By 1904, production had moved to Ohio and national distribution had begun, laying the manufacturing foundation for 130 years of HVAC market leadership.
In 1952, Lennox introduced its first commercial rooftop unit, launching the commercial HVAC segment that would eventually grow to 41% of revenue. The rooftop unit became the default specification for retail, office, and industrial buildings across North America.
In 2001, Lennox went public on the NYSE following its spin-off from Electrolux, becoming an independent industrial company. In 2012, management strategically exited international HVAC joint ventures to refocus entirely on the North American market, where its competitive advantages were strongest.
In 2022, Alok Maskara joined as CEO with a mandate to accelerate the margin expansion program. In 2023, federal CARR efficiency standards took effect, requiring residential HVAC systems to meet higher efficiency thresholds and effectively mandating the replacement of millions of units that no longer comply.
In 2024, AI infrastructure build-out drove record commercial HVAC backlog, with hyperscaler data centers requiring precision cooling systems that manage thermal loads at densities far above standard commercial applications. Commercial revenue grew 12% year over year, driven by this data center cooling demand.
Lennox generated $5.87 billion in fiscal 2024 revenue. Home Comfort Solutions residential HVAC leads at 59%, $3.5 billion, growing 6%. Building Climate Solutions commercial HVAC contribute for 1% at $2.4 billion, growing 12% on data center demand.
Adjusted operating margin reached 19.8%, best in class among HVAC peers. Adjusted EPS grew 15% to $17.50. Free cash flow of $700 million demonstrates strong capital conversion from the manufacturing model.
Lennox's primary moat is its dealer network. 7,000 plus authorized dealers who are trained, certified, and economically incentivized to sell Lennox equipment. Switching a dealer relationship requires retraining, recertification, and warehouse retooling, creating switching costs on the distribution side that are as durable as any brand moat in consumer products.
CARR is the second moat. Federal efficiency standards that took effect in 2023 effectively mandate the replacement of millions of residential units across the southern and southwestern United States. Lennox's compliant product portfolio positions it to capture a multi-year regulatory tailwind without any increase in competitive intensity.
Data center cooling is the third moat. AI infrastructure build-out requires precision commercial HVAC that manages extreme thermal density, a technical requirement that favors established commercial HVAC manufacturers with engineering capabilities over commodity equipment producers.
Lennox has delivered 12 consecutive annual dividend increases. Total annual dividends paid approach $160 million. The dividend history from $1.66 in 2015 to $4.20 in 2024 reflects 153% payout growth over the decade.
The dividend coverage is exceptional. $700 million in free cash flow against $160 million in annual dividends, a 4.4x coverage ratio. Lennox's capital-light manufacturing model converts earnings to cash efficiently, supporting both the dividend growth trajectory and ongoing share repurchases.
On the competitive radar, Lennox leads on dealer network depth at 90, operating margin excellence at 90, and commercial rooftop leadership at 88. Trane Technologies leads on commercial rooftop at 90 and data center cooling at 88, the commercial HVAC benchmark. CARR leads on residential market share at 88.
Johnson Controls scores lowest on operating margins at 65 and residential market share at 65, reflecting its focus on integrated building systems rather than residential equipment. Lennox's combination of dealer network depth and operating margin leadership is difficult to match in North American HVAC.
Lennox serves 60-plus million North American homes and businesses through 7,000-plus authorized dealers. Over 800,000 residential units are sold annually. 200,000-plus commercial sites are served. 400-plus patents protect the product portfolio. 12,000 employees support North American operations.
The residential replacement cycle is just beginning. CARR standards affect tens of millions of existing units across the U.S. South and West, and replacement timelines of 15 to 20 years for HVAC systems mean the Lennox dealer network will be processing replacement orders from this regulatory catalyst through the early 2030s.
Alok Maskara holds a BS in mechanical engineering from IIT Bombay and an MBA from INSEAD. He began his career at McKinsey before moving to Honeywell, where he held operations and business unit leadership roles across industrial divisions.
Maskara served as CEO of Dover Pump Solutions and then Luxfer Holdings from 2012 through 2022, building operational efficiency programs in precision industrial businesses before joining Lennox. His manufacturing operations background directly supports the margin expansion strategy he brought to Lennox in 2022. Lennox has sold HVAC equipment since Dave Lennox invented the riveted steel furnace in 1895, and the business today sits at the intersection of two secular tailwinds that didn't exist when they went public. The CARR regulatory efficiency standard forcing a 40 million unit residential replacement cycle, and hyperscaler data center build-out requiring precision commercial cooling that commodity HVAC can't provide.
The competitive advantage in residential HVAC is counterintuitive. It's not the equipment itself, it's the dealer network. Lennox operates through 7,000-plus authorized dealers who are trained, certified, and economically incentivized to sell Lennox product. And switching a dealer relationship means retraining, recertification, and warehouse retooling, which creates switching costs on the distribution side that are as durable as the brand. Lennox International just posted a beat-and-raise quarter, and almost nobody noticed. The HVAC giant cleared Q1 estimates by 7% on earnings, raised full-year guidance, and the stock barely moved. Today, we are breaking down exactly what Lennox delivered, what the replacement supercycle looks like from here, and whether 21 times forward earnings is cheap or a trap. Let's get into it.
Lennox International has been making climate control equipment since 1895. Today it operates two segments: Home Comfort Solutions, covering residential HVAC for single-family homes, and Building Climate Control, handling light commercial and specialty cooling. The company manufactures in the United States and distributes through company-owned service centers and independent dealers. If you have ever had a furnace replaced or an AC installed, there is a real chance Lennox made it.
Headquartered in Richardson, Texas, Lennox generates roughly $5.3 billion in annual revenue. The stock trades around $521, giving it a market cap of $18.1 billion. Alok Maskara has been CEO since 2022, methodically simplifying the portfolio, sharpening margins, and tightening distribution discipline.
All right, Hudson, let us get into Q1 2026. Revenue came in at $1.14 billion, up 5.8% year over year from $1.07 billion in Q1 2025. The analyst consensus was expecting about $1.12 billion, so a modest revenue beat.
More importantly, adjusted EPS landed at $3.37 versus the $3.16 estimate, a 7% beat. And then management turned around and raised full-year guidance. That is the classic beat-and-raise setup that traders love.
Now for context. Q1 is always Lennox's weakest quarter. In North America, nobody is buying a new furnace in January or February unless the old one died. Demand peaks in Q2 and Q3 when air conditioning season runs. So a Q1 revenue of $1.14 billion against a peak Q2 last year of $1.5 billion is totally expected seasonality, not a sign of weakness.
Right? And the margins tell the real story. Gross margin in Q1 came in at 30.9%, and operating margin was 14.4%. For a manufacturing company with significant commodity exposure, those are solid numbers. On a trailing 12-month basis, gross margins run at 33% and operating margins at 19.5%, showing that Q1's lower margin is mostly volume leverage effects, not price deterioration.
Cash flow was light in Q1, operating cash flow $16 million, free cash flow slightly negative. HVAC companies build inventory ahead of summer, so working capital consumes cash in Q1. Trailing 12-month free cash flow is a much more meaningful $661 million.
The balance sheet carries $1.9 billion in net debt. Against trailing free cash flow of $661, leverage runs about 2.9 times, manageable. Management continued returning capital to shareholders with $75 million in Q1 buybacks.
The revenue trajectory by quarter shows the seasonal pattern clearly. Q2 and Q3 of 2025 hit $1.5 and $1.4 billion respectively, the natural peaks. The 5.8% growth this Q1 signals that demand is holding up against macro uncertainty and tariff noise. That is the real headline.
Alok Maskara became CEO in 2022, coming from Kennametal, where he ran a precision manufacturing business. His playbook at Lennox has been straightforward. Focus on North American residential and commercial HVAC, exit low-margin international businesses, invest in direct distribution to capture more of the value chain. The operational improvements since his arrival show up clearly in the expanding margin profile.
The street is cautiously optimistic but not overwhelmingly bullish on Lennox. Analyst consensus is hold, with 7 buys, 9 holds, and 2 sells. The average price target sits around $560, implying about 8% upside from current levels.
On the bull side, Barclays, Oppenheimer, and several others have outperformed ratings, pointing to the replacement cycle durability, Tier 2-driven trade-up, and Lennox's direct distribution model. On the cautious side, Wells Fargo's equal weight reflects concerns about tariff exposure on components and the competitive intensity from Carrier and Trane Technologies, both of which are investing aggressively in residential HVAC.
Post-earnings, the reaction was muted. The stock moved a few percent in both directions before settling near where it started. That is actually typical for Lennox. It is not a high-volatility name. It is a slow-burn, compounding story more than a momentum play.
The key thing the street is watching for is the Q2 print. Q2 is peak HVAC season, and if Lennox delivers strong volume growth with price mix improvement in Q2, that would significantly re-rate the bull case. A strong summer print could push the stock toward the 600 range as the replacement cycle thesis gets validated at scale.
And there is the guidance raise to consider. Management lifted the full-year outlook despite tariff uncertainty and volatile input costs. That kind of confidence signal from the executive team is meaningful. It suggests they are seeing strong order books heading into the summer season and have enough pricing power to offset cost headwinds.
The bull case for Lennox has 3 legs. First, the Tier 2 efficiency mandate that took effect in 2023 requires all new residential AC systems to meet higher energy efficiency ratings, and millions of older units across the Sunbelt are not compliant and will need replacing. That is a mandated demand driver operating independent of consumer sentiment.
Second, the replacement supercycle. Roughly 45 million residential HVAC systems installed during the 2000s housing boom are now approaching end of useful life, typically 15 to 20 years. This cohort creates a massive, non-discretionary replacement wave that Lennox is uniquely positioned to capture through its premium positioning.
Third, operational leverage. Lennox has a relatively fixed cost structure with its manufacturing plants. As volume scales through peak season, incremental revenue flows through at very high margins. Combined with buybacks reducing share count, EPS can grow significantly faster than revenue. At 21 times forward earnings with those structural tailwinds, the bull case calls for meaningful multiple expansion.
The bear case is real too. Tariffs are the most immediate concern. Lennox sources compressors and other components from China and Mexico, and the tariff environment remains volatile. Even if Lennox can pass through cost increases via pricing, there is a lag. Margin compression shows up first, recovery comes later.
The housing market is the second bear concern. Replacement demand is more resilient than new home demand, but if consumers are stretched financially, high mortgage rates, high credit card debt, they may opt for emergency repairs over full system replacements. Declining ticket sizes hit Lennox's mix and margin profile.
Third, Lennox is in the middle of a refrigerant transition. The industry is moving from R410A to R454B, and that transition creates real friction. Installers need new certifications, distributors need to manage old and new inventory simultaneously. If the transition creates any channel disruption, it could affect near-term volumes.
And finally, the competitive landscape is intensifying. Carrier Global and Trane Technologies are both investing billions in North American manufacturing and brand development. York, the Johnson Controls HVAC brand, is also pushing aggressively in the dealer channel. Lennox's premium pricing power is not guaranteed to hold if the big players decide to compete on price.
How does Lennox stack up against its HVAC peers? The biggest direct competitor is Carrier Global, the former United Technologies spin-off that also makes residential and commercial HVAC under the Carrier and Bryant brands. Carrier trades at roughly 22 times forward earnings, actually close to Lennox's valuation, but with a much larger commercial and international footprint.
Trane Technologies, which makes Trane and American Standard systems, tends to trade at a premium, typically 25 to 28 times forward earnings, reflecting its stronger commercial building systems mix and services revenue. Watsco, the HVAC distributor rather than manufacturer, rounds out the peer set at around 26 times, emphasizing how the distribution play commands different multiples.
By gross margin, Lennox at 33% trails Trane, which consistently runs 35 to 37%, reflecting Trane's higher services mix and commercial weighting. But Lennox has been closing that gap through direct distribution and price discipline. The margin trajectory is moving in the right direction.
The valuation case is actually fairly compelling relative to peers when you account for LII's higher North American concentration, less FX risk, less international complexity, and direct exposure to the residential replacement wave that is one of the most structural demand drivers in industrials right now.
Options activity around Lennox's earnings was relatively contained. The put-call ratio ran at 0.82, slightly bullish, reflecting that institutions weren't pricing significant downside risk heading into the print. Post-earnings, the implied volatility collapsed as the results came in, without major surprises.
The most notable options flow was call buying concentrated at the 530 to 560 strike range for June expiration, essentially a bet that the stock rallies through summer as the peak HVAC season validates the demand outlook. That is a straightforward seasonal trade backed by the fundamental thesis.
On the insider side, CEO Alok Maskara exercised and sold shares in early 2026 as part of a pre-established Rule 10b5-1 plan. Those sales are planned months in advance and are generally not informative about near-term sentiment. More interesting was board-level buying. Directors accumulated roughly $450,000 in stock during Q4 2025, which suggests confidence in the recovery narrative from the people closest to the business.
The institutional ownership base is largely composed of long-only value and growth at a reasonable price investors, which creates a natural floor under the stock when it pulls back. This is not a name with heavy short seller pressure or active hedge fund battles. It is a steady compounder that rarely makes headlines.
Lennox delivered exactly what the bull case calls for: a beat, a raise, and operational discipline in a noisy macro environment. The replacement supercycle is real, SEER 2 is a structural demand driver, and direct distribution provides a durable margin edge.
The key metric heading into Q2 is residential average selling price. If mix shift toward premium high SEER equipment drives ASP growth, margins accelerate dramatically. At 21 times forward earnings, the stock price is in almost no growth. Boring, beautiful, on the radar now.
Everything today is for informational and entertainment purposes only, not financial advice. Do your own research and consult a qualified advisor before investing. All investments carry risk, including loss of principal.
Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. Visit chargedalpha.com. See you on the next one.
Ooh, we do. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall